Hello, friends. It's Donna Cates with Money Matters Wealth Solution. It's June 2026, and today I want to talk with you about something that matters deeply to your financial life. It can also feel noisy, confusing, and sometimes downright exhausting, and that's the market. More specifically, I want to give you a mid-year market check-in and talk about what all these headlines really mean for your retirement, your investments, and your long-term financial security. Because here's the truth, the headlines are loud. They are designed to get your attention. They are designed to make you click, worry, wonder, react, and sometimes second guess every financial decision you have ever made. But your financial life should not be managed by these headlines. It should be managed by a thoughtful plan. That is especially true if you're nearing retirement, already retired, navigating a major life transition, maybe rebuilding after divorce, newly widowed, single, supporting family members, or simply trying to make smart decisions without feeling like you need a financial degree to understand what is happening. So let's take a breath together and walk through a few things that are shaping the investment landscape right now. First, artificial intelligence is still a major force in the market. AI has captured a tremendous amount of attention, and for good reason. It is changing the way companies operate, how work gets done, how data is being used, and how businesses think about future growth. But from an investment standpoint, there is something important to understand. A relatively small number of large companies have been responsible for a meaningful portion of market performance. That does not automatically mean that something is wrong, but it does mean you need to pay attention to concentration risk. In plain English, concentration risk means too much of your portfolio's performance may be riding on too few companies or one hot area in the market. Now, this can feel wonderful when those companies are going up, 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 but it feels a whole lot different when they make a pullback. And this is why I do not believe in chasing every exciting headline. AI absolutely continues to be important. It may continue to create opportunities, but opportunity and discipline need to be and sit at the same table. You do not want your retirement plan depending on whether Wall Street stays in love with one theme forever. The second thing I want you to understand is the renewed conversation around IPOs. When companies go public, especially high profile companies, people get really excited. You may hear friends talking about it. You may see posts online. You may wonder, should I get in early? Am I going to miss something? And listen, I understand that feeling. Nobody wants to feel left behind. But IPOs can be risky. There can be a lot of excitement, a lot of speculation, and not always enough history to know what you are really buying. The better question is not, is this exciting today? The better question is, does this belong in my financial plan? That is the question that protects you. Because a good investment is not just something that sounds promising. A good investment has to fit your goals, your timeline, your need for income, your risk tolerance, and the kind of life that you are trying to build for yourself. For one person, taking a small speculative position may be fine. For another person, especially someone who is 5 years from retirement or living from their portfolio, it may be completely inappropriate. And this is where personalized advice truly matters. Now, the third topic or theme for the day is inflation. I know we are all tired of talking about inflation. We feel it at the grocery store. We feel it at the gas pumps. We feel it in our insurance premiums, utilities, repairs, medical expenses, property expenses, just everyday cost of living. For many households, inflation is not some economic chart. It is the feeling of looking at your bank account and wondering why the same money doesn't stretch the way it used to. That matters. Inflation is especially important when planning for retirement because your income needs to keep up with your life. You are not just planning for groceries today, you are planning for what they may cost 10 years, 15, or even 20 years from now. That is why sitting in too much cash can quietly hurt you over time. Yes, cash is always important. You need emergency reserves, you need money available for those short term needs, and you need stability. But if too much of your long term money sits in cash for too long, inflation can eat away at your purchasing power. This is one of the reasons investing still matters, even when the markets feel uncomfortable. You are not investing because you love volatility. You are investing because your future self needs your money to keep working. The fourth thing I want to talk about is employment and the economy. There's been a lot of worry about job displacement, especially with AI, and those concerns are not foolish. Technology does change work, it changes industries, it actually changes what skills are valuable. But so far, the labor market has shown more resilience than many people expected. That does not mean every household feels secure. It does not mean every industry is healthy. And it certainly does not mean every person feels protected in their job or income. But it does remind us that the economy is rarely all good or all bad. There are always cross currents. Some data may look strong while certain families are struggling. Some companies may be thriving while others are cutting back. Some markets may be hitting all-time highs while people still feel pressure in their everyday budgets. This is why I want you to be careful about making emotional decisions based on one headline or one news segment or one scary prediction that you hear. The economy is complicated. Your plan should be grounded. Now, the fifth topic today is diversification. Now, I know diversification does not sound exciting. It does not have the sparkle of AI. It does not make for a thrilling headline. But diversification is one of the quiet financial power tools that protects your financial future. Diversification means you are not betting everything on one company, one sector, one country, or even one asset class or economic outcome. It means your portfolio is built with the understanding that none of us gets to know the future in advance. And that is not weakness, that's just wisdom. There have been times when large U.S. companies carried much of the market. There have also been times when small companies, mid-sized companies, international stocks, bonds, or other parts of the portfolio have done better. The problem is that most people only want diversification after the thing they are concentrated in starts falling, and then it can be painful. A diversified portfolio may not always make you feel like you own the hottest thing in the room, but it can help keep you from making one bad bet with your whole financial life. And for anyone protecting retirement income, rebuilding after a major life transition, or trying to preserve wealth for the next chapter, this matters. Now let's talk about bonds and interest rates. For years, bonds have felt boring. Then interest rates rose. Bond values moved around more than many investors expected, and suddenly people started asking, do bonds make sense in my portfolio? In many cases, yes, they do, but bonds are not all the same. We've got short-term bonds, intermediate, long-term, corporate, municipal, government, bond funds, and individual bonds can behave differently. The role of bonds in your portfolio is not just about return. It may also be about stability, income, and having part of your money that is not tied directly to the stock market movement. But the right bond strategy depends on your situation. If you're living off your investments, bonds may play a different role than they do for someone still working and contributing to their retirement accounts. If you're going through divorce, liquidity and timing may matter more than chasing yield. If you're nearing retirement, we need to think carefully about how much risk you can afford to take and where your income will come from. And again, this goes back to planning, not guessing, not reacting, but planning. So, what should you do with all of this information? Here is what I want you to take away. You do not need to know every market statistic to be a wise investor. You do not need to understand every economic report to make good financial decisions. And you certainly do not need to chase every new trend to build wealth. But you do need a plan. You need to know what your money is for. You need to know how much risk you're taking. You need to know whether your portfolio matches your current life, not the life you had 5 or 10 years ago. You also need to know whether your investments support your income needs, your tax picture, your estate plan, and your long-term goals. Because here is where I get very direct. A portfolio is not a plan. An investment account is not a strategy. And hoping everything works out is not financial security. A real financial plan looks at your whole life, your income, your expenses, your retirement goals, your debt, your taxes, your insurance, your estate documents, your family responsibilities, your fears, your dreams, your risk, your next chapter. That is the work that gives you confidence, not because the market will never go down. It will. Not because there will never be uncertainty. There will be. But because you will know why you are invested the way you are invested. You will know what your money is meant to do. You will know when to stay steady and when adjustments are needed. That is a different kind of peace. So as we move through the second half of 2026, I want to encourage you to pause before reacting. Do not let fear make decisions for you. And don't let excitement make decisions for you either. Review your plan. Let's look at your portfolio. Ask whether your investments still match your life. Ask whether your cash reserves are appropriate for your needs. Ask whether your retirement income plan is clear. Ask whether your beneficiaries are current. And ask whether your risk level still fits who you are today. And if you don't know the answer, that is not failure. That is simply your signal to get guidance. You deserve to understand your money. You deserve to have a voice at the financial table. And you deserve a plan that gives you more than numbers on a page. You deserve a plan that gives you confidence, direction, and the ability to make wise decisions when the world feels uncertain. If this conversation has you wondering whether your investments, your retirement income, your cash reserves, or overall financial plan still fit your life, I would be honored to help you take a closer look. You're welcome to schedule a financially fit discovery call with me. I'm Donna Cates with Money Matters Wealth Solutions, and thank you for spending this time with me today. Stay steady, stay informed, and remember your financial future is too important to leave to the headlines.